Welcome back to the Money Focus Podcast. I'm your host, Moses the Mentor. And on this episode, I have the pleasure of welcoming on Bronson Hil. He's the founder and CEO of Bronson Equity, and he's also an authority on apartment investing, having raised over $40 million for real estate. He's also been a general partner in over $200 million worth of real estate around the US. So he's here to help us understand real estate syndication and how it compares to other investment methods. I'm excited to understand what he has to say. So let's go.
Yeah, well, I started out originally. I was a youth pastor, so I was really wanted to change the world, working with high school students. Did that for about 5 years. Did some overseas kind of service projects and things, and then got into medical device sales, which people say, well, it's very different than working in ministry or but I was helping people in another way. There's another way to help people, and it was a way to kind of grow my career. So I did that for 10 years. And it was doing really well, enjoyed it, was winning awards, and there's a lot of medical sales is great. I got to where I was doing heart surgical products and working with cardiologists and just very interesting stuff in the OR. So I'd go in and instruct on how to use this stuff. It was very interesting. And I was making really good money, like a high six-figure, salary and income, and doing really well. And the thing I didn't have, though, and a lot of people can relate, whether you're in the medical field or any other field, it's just that I didn't have control over my time. And I really wanted to have control over, if I want to travel for a week, or I want to take my daughter on a trip, or I want to go somewhere, I wanted to be able to do that. And especially in the medical field, there just weren't a lot of people who could take a lot of time off. A lot of times, if you weren't at work, you didn't get paid. And so my family, though, was saying, this is the golden handcuffs. Why would you ever, that's how I felt about it, right? This is a great job. Why would you ever leave your great job? And so I learned about syndication, which basically is a fancy term for, it just means raising, money from different investors. Either, there's kind of two parties. One is the operating team, or the group that's kind of raising the money, and the other is the investors. And then we go and we partner and we do deals together. So the investors get mailbox money, which is the name of my podcast. And so that's kind of, just some interesting things on how that works. So I learned, raise $100,000 from one investor I started a meetup in Los Angeles where I live. And then through some series of just networking and partnerships, I found another person and was able to scale up pretty quickly. And we raised $15 million over the next 18 months. And so it's just amazing how there's a lot of people that have a money problem. Not that they don't have money, but they have money and they don't know where to put it. They don't know how to invest it. And when you're someone who does the capital side, where you're finding deals and you're bringing people into great deals, or you're kind of a part of the operating team, it kind of allows you to get a piece of the upside as people invest along with you.
For a lot of people that might be listening and watching, the idea of, raising that much money, it just seems like a pipe dream, right?
Yeah.
It just seems like how does that happen? It seemed like you noted a little bit about it as to why someone would give you money to invest. But, is there a way you can expand on that a little bit more so people can understand, it's not necessarily like they're just giving you money to play with. You're actually putting those people in a better position financially by taking on that money, right? So you kind of just paint the picture for them, because if you say I raised $1 million, people say, get out of here. Like, I know a millionaire. So help us understand, the average person understand why a syndicated deal can actually produce that amount of money coming in there from, ordinary people.
Yeah, I mean, it really is something that kind of surprised me when I first started. I mean, I heard about, okay, people are doing this, they're raising money, whatever. And I was like, well, how does that even work? I mean, I look back now, it's been like 5 years and I raised $40 million. That sounds absolutely insane. $40 million, that's so much money. And it's not like there's just like money sitting in an account, or I've got like it all goes into deals, it goes into things. But the reason why someone would do that is, let's say I'm a physician and I make over $500,000 a year, $200,000 a year. A lot of people get this where they get into situations where they buy a rental house or two, or a vacation rental, or they're doing a stock trading thing, but then they realize, once you own 2, 3, 4 houses, it's not passive. Even if you have a property manager, you're active in that. Even if you're not the one who's doing it, they're calling you saying, hey, the tenant didn't pay, or hey, we've got a repair, or what do we do? And I tell people, if you can't 10x your current strategy as a passive investor, then you're not actually passive investing, right? So if I have 3 rental houses, and if I couldn't pretty immediately go to 30, let's say I have the capital to deploy to do that, But then like that is a full-time job, not even just to manage it, but to asset manage it, right? People are going to ask, hey, what happens? Maybe a part-time job at least. But so people will sometimes think things are passive. And that's why I talk about my first book, Fire Yourself, where it's like, how do you actually replace your working income with passive income in 3 years or less? And so a lot of people have a money issue where they're making money and they don't know where to put it, where it can grow wealth without taking up more of their time. And so this is where the term financial freedom, you say, what does financial freedom mean? Most people would say, well, it really means money. But if you get to the core of it, it's that I want more time. Because if you have way more money, but you just added another job for yourself, you gave yourself 10, 20, 30 hours more a week to do, that's not freedom, right? Freedom is maybe you do a little work on the front end and then you get that mailbox money, you get that direct deposit that comes in each month. So that's what we created for people. And again, there's a lot that goes into that. You think about anybody you would invest with something, you got to, okay, what's their background? Who's the team? For me, I didn't have a ton of experience. I had some real estate experience, but I didn't have that experience in multifamily. So I had a partner that had 25 years of experience, right? So it's the team's experience. So it's much more of a team sport than doing individual single family. So there's two sides of it. One is, for me, I was making good money, but I didn't really have a lot of savings. So I was like, well, I'm going to leverage my time to get more wealth. And people that have more money than they have time, they can use their wealth to basically start to replace their income, replace their living expenses, get cash flow, get appreciation. But really, people come to us for three reasons. We're solving one of three problems, or maybe all three. Cash flow helps you cover expenses, helps you retire. You can, covering living expenses. Once you do that, you basically are financially free. Even if you don't cover your income, you can cover your living expenses. Second one is appreciation. So, property goes up in value. There's a long-term deal. That's one thing. And the last thing is tax benefits, right? We all pay taxes on things, and particularly if you're a high earner, you pay a lot in taxes. So if there's ways you can reduce that, those are all reasons people come and work with us.
I think the biggest thing, and you can relate to this because you were in sales, you can't sell with other people's, with your wallet. You know what I'm saying? Like, oh, I can't afford that, or I don't have $1 million, right? Because it sounds like you took your sales background, your access to people who also had money as well, and used that as an opportunity to grow your business. So just because you raise $40 million doesn't necessarily mean you have to have $40 million. It just means that you bring a product or a service to the table that can help someone with money grow their money. So it's just one of those things. And my show is really designed for that, to really help people with their mindset to understand that some people do struggle to put food on the table, and we empathize with them. But there's some people that really have too much money and they don't even know what to do with it.
Yeah.
So if you can figure out a solution for that and get them a better return, then you may have the opportunity to get them to invest with you. So I think that's essentially what it sounds like it is.
Yeah, it really is. It's really, having talked with, a lot of wealthy people, over 2,500, wealthy people to interviews with, and just, these are millionaires who average net worth of 2 million or more. And it's just a lot of people, they're in a place where they are trying to figure out how to grow their wealth. And if you're not in that place, then I think, there's a saying that says, make yourself valuable to valuable people. And that really is what helped me to approach that partner. And we were able to create this part. I wasn't even planning to hey, we're gonna create this partnership, but I was thinking, how can I help this person? And so if you're with somebody that has a lot of resources and you're trying to solve a problem, I would pay a lot of money if you could solve some problems in my business, right? You get more clients, you get more things, you produce this, we help in these, I get more time back. I would pay for that, right? I would pay a lot for that. And I'm sure probably you would as well. If we can do things that really create value for other people, especially people that have resources, they're willing to pay. Because at the end of the day, if I could pay somebody and they could solve all of my problems in my business and in my life, and I could just do whatever, I could go start another business, I could go travel, I could go, but that's how I've set up my business, where now I have a little bit of both, where I was able to travel 6 times internationally last year. I have a lot of things. I do a lot of these Spartan trail races, and I just do, I do the things that really give me life. And so I think we really try to help people design their lives in a way that, they're able to scale wealth quicker and, be more passive in it.
Nice. My wife and daughter, they're doing a Spartan race. I'm not confident yet. They're doing one in North Carolina.
Oh,
I think it's
nice.
like October. Yeah.
Oh, fun.
So
Yeah, they're
good luck.
intense. They're optional. You can do whatever obstacles you feel comfortable with. But I kind of did it, and I fell in love with it, and now I do it competitively. And I haven't done one in a little while because I was been kind of back and forth. You get older, you start getting injured, and so you kind of get in good shape, then you go, and then trying to get injured, and you just keep doing it. So
Cool, cool. Well, let's talk about the market right now. How would you describe the current real estate market for syndication? Is this a good time for people to jump in?
it's a pretty broad term. It's really the legal structure that we use to put different like pool investments together and set it up as what's called a private placement and get the documents to do that so that we, like when we buy an apartment building, let's say it's a, $50 million apartment building and we put, 10 or $20 million down, whatever. We start this company that's an LLC. And because of this paperwork, it's a syndication that we put together. Now you can do it with multifamily real estate. You can do it with self-storage. You can do it with other things in real estate. You could do it with car washes. We've syndicated a car wash deal, multiple car washes. We've done it within the ATM machine space with an ATM operator. We've done it in oil and gas. We've done it in VC. So, and we've done it in real estate developments as well. So there's different things people can do it. And actually people can actually syndicate a coffee farm in South America. I know people have done that. I know guys syndicating like an airplane that they're leasing out. So syndication is kind of the broad term. So I think it depends. In real estate, we can talk specifically about real estate. I think the last couple of years in real estate has been really challenging for a lot of people. We really haven't done new deals in the last 2 years up until very recently. We started getting back in. We're seeing some pretty significantly discounted multifamily properties, which is great. So we're seeing more opportunity there. I think that whatever time you're in, I think the challenge is sometimes we say, I want to be in at the right time in the market, or is this a good time or a bad time? Well, I think in any market, there's always going to be risks. There's always going to be, positive. There's going to be pluses and minuses. So I think that, they say the best time to plant a tree was 20 years ago. And the second best time is today. So I think in some ways, like we wait and the grass grows under our feet and we're like, I should have, whatever. And I mean, the problem too, this is what a lot of people don't talk about. I've actually got a free guide for your listeners. It's called How to Use Inflation to Your Advantage. And I think inflation is not 3% or 4%. I think it's more like 6, 8, 9%. So if that's the case, if you got 100,000 sitting in a bank, if you wait a year, you're losing 6, 7, 8,000 bucks just sitting there. So I'm a big one. I like to deploy in assets I find safe. Some people like to kind of like, they'll wait and they'll save and then they'll wait for like the perfect time. But I don't know necessarily that we're going to have another 2008 or 2009. I think they've created so much new currency. We've seen probably a 50% increase in the currency supply in the last 4 years, which is insane. And that's why when you go to the store, and they've done studies that show this, like stuff costs 50% more. So if you know that, and I really think inflation is going to continue. So if you know that, if you buy assets such as real estate, such as other, businesses or other sorts of even things like precious metals, whatever the things are, those things will hedge inflation and they'll help you to grow. So I think it is a great time. I think we're going to look back right now. I mean, honestly, you look at it this way, interest rates are higher, which typically keeps asset prices lower. Well, what happens if and when rates start coming down to more like, maybe we come down to 5% and we come down to 3%, but we come down lower again, which I think at some point we will, that will cause the price of assets to go up. Even if it doesn't come down, I think that we're going to need more, a lot of, whether it's real estate or other sorts of business, things, that there will be a hedge against natural inflation. So very long answer, but I think I think it's definitely a good time.
Oh, I appreciate it. And, enlightening me and the audience about syndication as a whole, because when I hear syndication, I'm thinking about apartment buildings and stuff like that, but you broke it down, that it could be pretty much anything. It's the process of, like you say, gathering the money. So that's pretty cool. So I appreciate that. When it comes to real estate syndication in particular, what benefits are there versus other, investment opportunities for someone? Like, do you still get the tax benefits, for example, if you invest in a syndication versus like truly like buying a rental property or something like that? What can you kind of outline what opportunities someone may have for a real estate syndication as opposed to, saying, hey, I want to go and put it in the stock market, for example?
Yeah. So real estate in general has a lot of tax benefits. So if you own a house and it's a rental house, even if it's your own house, you can depreciate, the value of the house over 27 and a half years. You also get a write-off on any interest you paid. So there's some natural write-offs there. So real estate in general is great. Now, Multifamily or other larger real estate, there's been crazy additional benefits as well, where up till a couple of years ago, you could take up to 100% of the value of what you invested, and you can have a loss for year one. That again, what we're doing is we're accelerating the depreciations. We're bringing the depreciation forward to this year, and then if you didn't hold it for the number of years, you just recapture that in the back end. But what it allowed you to do was to get into deals, have gains, or maybe you sold a house. You had 100,000 in losses they're not losses, but they're passive losses, so they're paper losses, and so you could use that against $100,000 gain on some other investment. I'm not a tax person, no specific tax advice, but there are definitely some additional benefits. It's not quite as good as it was before. They've reduced the percentages. So instead of 100% depreciation, a lot of times it's like the max is around 60%. But again, that just means how much you use forward. You still get more in year 2 and year 3, and you get more kind of in the future. But yeah, so that's kind of what it looks like. So, but I would say there definitely are benefits. And again, if somebody has a tax issue, there are interesting things that are out there. I mean, the hardest, you can basically, if you are what's called a real estate professional, you can have lots of depreciation, and you can reduce potentially your own income based on this depreciation, or other people's, maybe your spouse, you can reduce their income. Let's say they're a physician and you're a real estate professional. There's a way that you can actually reduce your taxes there. And I can get more into detail. It's a little bit in the weeds, but I was able to reduce my taxable rate from about 25% to about 1% by using that method, right? Mm-hmm. There's another method that's for people that are high earners or just a W-2 earner, right? That's the hardest income to try to reduce. But in the oil and gas space, there's a way that you can reduce, commonly 85%. So you invest, and then about 85% is what actually gets reduced against ordinary income. And that never recaptures. That's just like a reduction of income. And so you pay less taxes. So you obviously want to make sure you're in a good investment and things like that. But I would say, going back to your question, comparing single family or doing it yourself versus syndication, I would say it depends really how active you want to be. If you want to be the one who's swinging a hammer and cleaning, doing all the stuff yourself, or maybe you have a manager and you're kind of managing them. Some people do it and they do well and they enjoy it. I just think it's a lot of tasks to do, and it's a lot of checking on people to make sure they did it, because no one really is going to care for that asset like you do. Typically, if you have a property manager, they're just trying to kind of like do well enough so they don't get fired, honestly, as a property manager, or they're not trying to do, not too well because maybe you'll sell the house. It's like, so it's kind of it's a little tricky. But when you're in a syndication, it does give a lot of other benefits that, you're passive, you get time back. There's typically a little more tax benefits. And then you kind of come in a combination of both. You get appreciation and you get cash flow. Now, if people are investing in single family now or doing themselves, typically you're primarily only going for appreciation. Cash flow, you can get it, but it's very slow. It takes a very long period of time. And I can get into specific examples of it, but I think that you're typically going to have a better experience with the tax benefits and cash flow in larger deals, such as larger multifamily deals.
Well, for me, I invest in Cleveland. So, I'm there for the cash flow, but I know I live in Atlanta. So for anybody who's buying rental properties in Atlanta, they're looking for appreciation. So that's pretty much what you're seeing now, because it's so hard to get cash flow with, rental properties. You have to go to places like Cleveland or, Midwest for the most part. But you do have to be a part of it. It's not completely passive.
Right.
I self-manage my properties, but I still have to ensure that things are being done correctly. So it is a little different. But I do want to ask you about a syndication, a real estate syndication is still kind of set up for an exit, right? So when someone invests with you, how long does it typically take before, you guys actually may sell a property? Is there a sweet spot that you like to do it, or it just depends on the real estate cycle?
Yeah, so there's a couple of things that go into that. We typically project around 5 years, and you say, why 5 years? Well, a lot of loans are kind of 5-year term, or it just kind of gives you enough time that if things take longer than you expect, or the market has a snag, you don't have to sell when you don't want to sell. The biggest challenge a lot of times, and we've seen this the last couple of years, if you don't have to sell right now, it's better to hold on to a property often, because at least in the multifamily across the country, there's a lot of, multifamilies drop 20 to 30% in the value just from rates rising. We haven't seen it in single family because 40% of single family homes are owned in cash. There's no loan. And there's a high percentage maybe of the others, maybe half of the other ones financed more than a couple of years ago, right? So they've got this super low rate that they can't sell. Well, in multifamily, it's different. A lot of these loans turn over every 3 to 5 years. So a lot of them, they'll project out 5 years. And then, for example, one group that we're partnered with, they've done over 50 deals the last 5-6 years. And, they've had, I think, 11 exits. They've done very well on their exits. But they have in-house property management and in-house construction. So you can see, they know, hey, well, every time we turn a unit, means we'll come in and we'll do a full renovation. We'll have our own group come in as construction. They'll do it. It'll take this amount of time. Might take 3 months or whatever the time frame is. And they say, well, and the increase in rent after we do that is $452 a month, right? So we know we have all that data. So if we can get done, if they can finish that with, in less than 3, they say in less than 3 years, they know they can renovate close to 100%. You can never get quite to 100% because somebody wants to stay in the unit forever or whatever, but you can get pretty close to 100%. So within 2-3 years, you're at 80 to 100% of the units. At that point, you evaluate and say, well, we've increased the rent this amount. Rent's gone up on average in the property by 30% or 20% or 50% or whatever that number is. And how did that change the value of the property? Well, if it makes sense at that point to sell, we'd rather sell at 2 years or at 2.5 years than to hold longer and not sell and just is because in these type of deals that we do, they're typically like when you come into a property that's not nice and you make it nicer, just you think of like a single family flip, right? You come to a place that's kind of not very nice, you make it nicer. The value is made as you make it nicer and you're able to increase those rents. So once you've done that, you've added all that value across the different properties, off the different units. It's actually a great time to be able to sell because that's kind of when you maximize the return. So every year you hold it longer, you're reducing the IRR, you're reducing the returns for those, like the more years you hold it.
Yeah, that's the cool part about commercial is because it's not measured on comps or anything like that. So once you've done the work to optimize the property, like you mentioned with the rents or, I don't know if you start charging for parking or something like that, whatever, income, the net operating income, if you feel like, hey, we're at, 95% or whatever we projected for, you don't have to worry about Moses's apartment building down the street. That's an eyesore, because it's really only about your building. So I think that's pretty cool. So what about can anyone invest in a real estate syndication? Or do I have to be, a real estate professional? Do I have to be recognized by the IRS as someone who is an informed investor? Is it closed in any way?
Yeah, so there are some deals that require what's called to be an accredited investor. It doesn't mean you get a gold star. It just means you have a certain net worth, typically over $1 million, not including your primary residence, or it's either $200,000 or $300,000 in income per year, depending on if you're married or if you're single. So there are some deals we have that. We have some that are not for investors. We can't share. Some areas we are not able to share unless we have a call. We have some sort of financial relationship with individuals, and so that's kind of how we set it up. So we have both types of deals. Some of the more alternative stuff, the more business related, or car washes, or other oil and gas. Some of that's only for accredited investors, but then some of the other stuff is for the multifamily syndication is for individuals that are just are not accredited. So we kind of do different types of deals for different folks.
I really don't understand why that's the case though, but
yeah.
I guess that's the rule, but
I think it shouldn't be. I mean, they've talked about doing the SEC starting up to make it like a test where instead of it being by net worth and income, to say you take a test and then if you pass this test, you show that you have a level of sophistication. I think it'd be way better. But I think that there also is a side too. If somebody's got a $2 million net worth, and they're invested $50K into a deal, that's very different than someone's got $100K or $200K. It's just a much higher amount of their net worth. So I do understand that, but we all know this, that the amount of money you have doesn't mean you're more sophisticated, right? It just means you have more money. We all know people that have had money, and you look at the studies against people that are lottery winners or even sometimes professional athletes. They're not really trained. They just kind of almost got this money out of nowhere, and it's like, how do I do this, right?
But, on the flip side, what's stopping me from, going on the stock market and putting money in a brokerage account? So there's nothing. So
buying Bitcoin.
Yeah. It feels like, do it Bitcoin and, all this other stuff. So, but it's good that there are options, but it's could be limited on what you can actually offer to someone who's not in that that doesn't fit that criteria.
Yeah,
And that's
exactly.
that's not a your rule. That's a government rule, correct?
Yeah. Right. Yeah. And it's something they've taught. They may change. You take the test. You are accredited. Doesn't mean you can get into any deal at that point. You still have some net worth requirements and other things. But I've met people that, based on the definition I shared with you, some people that are retired that, or they don't make enough, but they have a net worth of like 1.5 million, but they're still not considered accredited because most of it's in their house. So just even the definitions are weird. So I don't know. I think eventually they may, hopefully they'll change it, because it just doesn't always make sense for a lot of people.
Let's talk a little bit about yield. So, it's a reason why people give you this money. You're returning their investment. So what can someone typically expect from a real estate syndication deal? I know you said within 5 years is like your typical turnaround, but is there a target ROI that you look for your investors?
I think it depends on the deal, depends on the type of deal. We have some that are, I would say generally a real estate deal. I'll just kind of give a ballpark. Let's say it's a multifamily deal that's, 100 units or more, and it's typically buy somewhere in the Southeast where there's a lot of growth. So kind of like the area you're in, Atlanta, or other areas. We're doing stuff in the Carolinas and in Texas and Florida. Let's say we have a deal. We want to see that as we project out the next 5 years that we can get at least a 15% average annual return. So sometimes it's a little higher than that, sometimes a little lower, but generally that's kind of a decent return. And if you're at 15% per year, about every 5 to 7 years, you should double your money, right? So I think if we can find something that's about 1.8 to 2 times the money, that's called an equity multiple. So if I invest 100,000 in this, I want it to be at, at least 180 to 200,000 when we're done. So some of that will come through cash flow, some will come through appreciation. And so, but again, it depends on the deal. Some deals are considered, more conservative, a little more safe, solid. Maybe they're 12%, and there's some that are more aggressive that are 25%. So it just kind of varies depending on the deal. And so you have to look at, we've done some development stuff, which is higher return, but there's a little more risk there because it's development. You don't have, you're trying to build this thing straight out, and it's a little more work to kind of get that going.
When you do the math, the simple math is, at the end of the day, if you're getting 12 to 15% return, where else can you put that money? I mean, you can have a 12 to 15% return on the stock market. You could, but it's going to be volatile. I think from the long stretch of time, the averages are roughly about, you hear anywhere from like 7 to 10% or something like that. But this is a shorter period. It's a true asset, that you're owning, and you can nearly double your money within, a relatively short amount of time. So it just really cements why people would be open to investing in a syndication with you. So
right.
It makes
yeah, I think it is. If you look at historical commercial multifamily or other commercial real estate over a long period of time, it significantly outperformed stocks. Yeah, and of course you get the benefits, the tax benefits. And when you buy and sell a stock every time, unless you're in a retirement account, you're paying a pretty substantial fee every time, especially if it's short term. If you have it more than a year, you pay maybe 15, 20%, but otherwise it may be 30%, maybe much higher depending on your tax rate. So I think, anything you could do to try to find things outside of Wall Street, there's obviously a little more knowledge, a little more things you have to educate yourself on. But I just think that, Wall Street, and these are the options that are really people are educated on, is do a 401k, get your money in stocks and bonds. And I just don't see these as very safe investments. I see them as really one-sided to really benefit Wall Street, no matter how you do with it. If you lose half your money, they still get paid. And like, it's to me, it's really crazy. But that's why, that's why the educational side, and that's in my book, Rich Brain, I talk about is like, there are specific wealth habits and things that wealthy people do. And one of them is they have a like learning as a job or never ending learning. They're actually so committed to it. A lot of like Mark Cuban, Warren Buffett, Oprah Winfrey, these people read, hour or two or more a day. Like it's tons and tons of reading. It's not just business, not just investing, it's all kinds of different things. And what it does is it really helps to bring growth and learning and how to make money and how to grow. So I think all this stuff is super, and shows like this are super valuable as well, Moses.
Well, you start talking about your one of your books, but right behind you, let's talk a little bit about Fire Yourself, because that's pretty much inspirational to me, because I still have a corporate career as well. So I'm blessed to have a great role. But at the end of the day, I'm looking to fire myself.
Yeah.
In there. So talk to us about the Fire Yourself, and then a little bit more about your latest book as well.
Yeah. So Fire Yourself, the subtitle is Replace Your Working Income with Passive Income in 3 years or less. And just how would someone do that? If they're making money, how would they go about that? If I'm somebody who's only done stocks or doesn't really know a whole lot about investing, this is just a great, guide on how do you get started and what are the different assets that are out there and how do you vet and deal. I have something in the book called the deal funnel, right? Of the deal flow funnel of how do you go. There's kind of a method I use to analyze the market, whatever that market is, whether it's real estate or ATM machines or car washes, or how do you know that's a good market to be in? Who's the operator you're working with? And then what's the actual deal and how does that make sense? And what are the ways you can make money? And more importantly, what's the one or two primary risks, how you could lose money? So those are all things that are important. So that book, it's been an Amazon bestseller. I'd love the ones available on Amazon. And this other book here is Rich Brain, which is how the wealthy change their brain to change their bank accounts. I'm in the process of writing this right now. And, again, in interviewing 2,500 millionaires, over 2,500 millionaires, I've learned that there's a few things that really are very different about how wealthy people act and the things they believe. And there's a belief, Moses, that people are either wealthy, they come from money, or they don't. But the facts are actually very different. In 2019, Fidelity Investments did a study and found 86% of millionaires are self-made. So that means that they did not come from money. So if that's the case, you think that's just kind of almost, it was very shocking. It's still shocking to me. 9 out of 10 almost people that are millionaires, they didn't come from it. So there are things that they learn. There are things that are habits that they learn to do. And there's a way of, when you change your actions, you actually change your brain. If you take 10 deep breaths, they actually can measure in neuroplasticity in your brain. It actually has changed the way that your brain functions. So it's the idea we are what we repeatedly do. So if you want to change the outcome, you change the action, which changes your brain. So this is called Rich Brain because so how do we go from here to there?
Nice. When is the book coming out?
Hopefully this fall. So I'm in the process of writing it. So I will keep you posted. And when, as soon as typing as fast as I can, but, trying to get the information out there, but it's been a lot of fun.
Gotcha. No, that sounds great. I mean, 2,500 people.
Yeah, it's a lot.
So it's a lot of knowledge share going on. So I definitely want to tap into that for sure. So keep me posted.
Yeah, for sure.
So what final advice or thoughts do you have for the audience about, anything, passive income or even just the real estate syndication game in particular that you would like to share? And then also close us out with the best way to reach you, your website, social media, etc.
Yeah, sure. Sounds good. Yeah, I think there's a few things from the book. I'll just share one thing that's really valuable, Rich Brain. But the idea is we're the average of the 5 people we spend the most time with. And so one of the intentional things, I call it net worthing, right? It's not just networking, it's net worthing. But it's been said how you treat your network is how you develop your net worth. And so if I'm the average of the 5 people I spend the most time with, if I looked at you as a listener, as an individual, I could probably say, this is, if I talk to your 5 closest friends or family or whatever people you spend your time with, it would be like, I could probably figure out what your net worth generally is. I could figure out what sort of health habits you have. I could figure out what sort of spiritual practices, so if you want to change in those areas, like for me, when I started running Spartan races, I had to get around. I hired a coach, right? I get around somebody who's literally won like world championships at Spartan racing. And so then I started meeting with him, and it's been great. And it's caused changes in my body. And it just, as I get older, it's trying to just really maintain and not injure myself as well. But it's the same with wealth. If I want to grow my wealth, if I'm the wealthiest person in my family or my community, then it's going to be hard for me to grow my wealth beyond that. I mean, I can still try and do what I do, but if I want to get to like 10x, I've got to get in the room with people that are 10x or 100x of my net worth. And by doing that, just by what they're saying, they're going to be able to share all kinds of things that are going to help me get there. So I think that's probably the biggest tip. If people want to reach out, this has been a great show, man. You got a great thing going on here, and I'm really happy to be on this show. I have a free guide that I created. You obviously can check out my book, Fire Yourself, which is on Amazon. So you can certainly check that out. And then I have this guide that is how to use inflation to your advantage. So if you're tired of paying more at the grocery store and the pain at the pump, you can text the word inflation to 33777. So the word inflation, you can text it to 33777. And it's this 40-page guide that just basically gives all these ways that are not even, so I haven't talked about some of the methods on here of how do you actually benefit when there's inflation. And again, I think inflation is actually substantially higher than what it's being reported as, but that's a gift to your listeners. But this has been a lot of fun being here. I'm on all the social medias. You can search Bronson Hil. My show, my podcast is the Mailbox Money Show. And it was really great to be on the show with you today, Moses.
Thank you. Thank you. And, inflation is such a buzzword right now, and everybody's feeling it. So that free guide that you're providing to help people actually benefit from it is game changing. So I'm definitely going to do it myself. So I appreciate you, Bronson.
Thanks, brother.